Welcome to Business Talk, where the markets might be unpredictable at the moment, but our conversations certainly never are. I'm Michael Avery, and if you've been keeping up with this series, you'll know today's guest is someone that I look forward to chatting with almost as much as I look forward to my first coffee in the morning. That's certainly saying a lot. Wendy Myers, head of PSG Securities, is back with us, and Wendy has this uncanny ability to make everything in markets, even corporate actions, those mysterious events that can either make your portfolio sing or cry, sound almost fun. So grab your notepad, because today we're diving into how these corporate events can impact your investments, and most importantly, how not to panic when the headlines hit, as we always say. Wendy, great to have you back on. Let's just start with the basics. Corporate actions. It sounds like the fine print on the back of a cereal box. Most investors know that they're important, but I don't know how many actually read them or pay attention. So maybe you could just walk us through the main types of corporate actions that can impact portfolio performance and why investors should care.
Yeah, thanks, Michael. So I think it's one of the small print items of owning equities that a lot of investors dismiss. But to my mind, corporate actions are critical. They give you insights into the company's strategy, into their financial health. So it's extremely important for investors to understand for their portfolio what corporate actions are impacting their portfolio. And I think, there's many corporate actions, and they often sound very complex. But if you actually break it down, it's very simple. But because it has an impact on your performance, both positive and negative, it's important for investors to understand that. You need to be aware. So I think what's important for me is that investors often don't understand. They think a corporate action is a cash dividend and whoop, I've got more money in my portfolio. What investors need to remember is that corporate action can either be voluntary or elective. So elective is where the investor chooses to participate, and it's important to understand what are the options and what impact will have on my portfolio. And there are obviously it's an obligation to participate. So in other words, you participate just because you're a shareholder, and that's fine because the path is defined by the issuer. But the key item to remember is that corporate actions, you can interpret from what's happening, whether a company is in a strong financial position, and what its prospects are for the near term. So let's delve into what are the types of corporate actions that can impact an investor's portfolio. So let's start at the simple one. So dividends, cash dividends, we all understand them. It adds money to my portfolio. I think that's generally seen as a very positive impact for you, the investor. But also be aware that if you keep the cash in your portfolio and you don't act on it, and you're in a rising market, you're earning interest. We've spoken about this before, Michael. It's going to negatively impact your performance because interest is really just inflationary. It doesn't add real capital growth to your performance. So I think investors be aware of the timing of that cash coming in and actually have a plan of how you're going to invest it, because you've got to have a view on the market if it's rising or if you're nervous and you want to sit on the sideline. Then another corporate action that I'm always very fascinated by are stock splits. So this divides the value of a company's outstanding shares, which sounds weird. Why would they do it? But we've seen lots of examples of this offshore in the technology sector for those shares that have had excellent runs. So Google, Amazon, and in the last couple of years, NVIDIA, you will see they've all gone through stock splits. The big question is, what does that mean? Well, it makes the value of the share price a lot less because there's more shares in issue. So it's more affordable for the retail investor. And that's generally a very good outcome for the share because more people can invest. There's increased liquidity and it generally assists in driving that price up, which obviously benefits your portfolio. Then you've got something like a spin-off. So that also sounds like Greek, but actually it's very simple. It's basically where a listed company divests part of its assets, and investors will own the original share and the newly spun off on the new share. We had an example like this last year on our local exchange where Transaction Capital actually spun off We Buy Cars. And We Buy Cars, I'm sure you've been following that share performance. It's been spectacular and it's had really positive benefits for those shareholders that have retained their investment. So that's a classic example where a spin-off really does work for the investor and adds to your portfolio performance.
But I think, what you've demonstrated is underlying all of this is when you're investing in the markets, if you're a shareholder, if you have one share in a company, if you have 100, if you have 1,000, you're part owner of this business. I mean, that's what a shareholder is. And so you get to vote and have your say on these corporate actions, the strategic direction that the company is taking. And not everything will go down to a vote. But I think, you need to be mindful of the fact that more than just being a receptacle of dividends, as you say, you should be an active participant in these and understand that it does impact the trajectory and the direction of the business. So it's not just boardroom jargon. Now, you've often mentioned that staying informed is half the battle. What are some practical steps that investors can take to ensure that they don't get blindsided by corporate actions that could derail their portfolio performance? Because if you've got maybe a well-diversified portfolio of 25, 30 stocks, it's a lot of companies to keep tabs on.
Well, I think, Michael, that's why people often see being invested in equities is a lot of hard work. Because in my personal capacity, because I'm in the business, obviously I have a share portfolio. I keep track of corporate actions. I look at the events diary, and not just of what I've invested in, but also what's on my watch list, because I want to be aware of what's coming up the list on those stocks that I'm interested in investing in. I want to get a feel for their financial situation and how the corporate action reflects on them in the near term. I think it's extremely important, as I've said, to stay informed about potential events. You need to do your research. You need to understand the implication. You need to, if possible, think of diversifying your investments. If we always talk about try not to have too much, more than 5% of your portfolio in a single stock. Be conscious of that in the context of the corporate activity that's happening. Pay attention to company news. Read about those mergers and acquisitions. Understand what the spin-off means and why the company is doing it. Don't be a lazy investor. Be an active participant because, as you say, you own a share and that board effectively works for you. So make sure that they're doing their job. Do the research and follow the financial news. And then make sure that what you're reading about actually aligns to your investment goals and your risk tolerance. That's critical. And then reflect on, if you are uncomfortable, is this maybe the time where a financial advisor can really guide you? And any good trading platform will certainly keep you informed, will guide you for elective events. And that's always the mark of a good platform. We've spoken about it before, but really consider if it's time for a financial advisor to be an active player in your portfolio and how you manage it.
I think, especially when it comes to complex M&A or things like that, always good to get a financial advisor in because nothing ruins a good day, quite like waking up to finding your favorite stock has pulled a vanishing act worthy of a Houdini because you weren't following a particular deal and now it turns against you. Maybe there's a bad actor involved and all of those things. I mean, we have the good, the bad, and the ugly. Now, when you think of it, there's a lot for an investor to take in here. How can an investor tell whether a corporate action is positive or negative for their portfolio? And even dividends, we think, oh yeah, we're getting money. Is that actually a sign that the company giving you cash back is not confident maybe in its ability to outperform its own cost of capital? Sometimes it would be better to rather buy its own stock back. Is that the right strategic decision? There's exactly a lot to consider.
I agree. So I see cash dividends as very positive. It's a very strong reflection of the company's financial health. And it's nice for the investor. Some investors, they use their share portfolio to fund their living expenses. So that's where dividends are a positive. But for those investors that aren't there yet, that are still growing their wealth, that's the perfect opportunity to reinvest either in the company that's issued the dividend or a new one on your watch list that you've been waiting for funds to invest in. So I think that's my top one. I'll be honest with you. Stock splits, that's actually regarded very positively. As we've said about Google and Nvidia, when the stock price is less and more stocks are an issue, it generally means that a wider range of investors can afford it and it has a very positive impact on the share price, positively impacting performance. Bonus issues, very similar to stock splits. Again, it's seen as a very positive impact on your portfolio. And mergers and acquisitions. So that's always a fascinating one. I mean, as you say, they can be quite complex. You need to do a lot of research into the reasons for it. Sometimes it can be positive in that it can lead to increased market share, higher profitability for the combined entity. But ultimately, the shareholder needs to look and see, is that M&A going to keep the ethos of the company as it should be, or is it going to dilute it? So that's why I would highly recommend doing a lot of research when these are announced. Rights issues are one of those events where can be positive and negative. Rights issues generally is where the company is asking for further capital from shareholders. And it's great if the company is going to use this raised capital for strategic growth initiatives. But if the company is using it to cover losses, then it actually can be very, very concerning. I think, and then we need to look at what are those negative corporate actions, like delisting. Obviously, it's a negative because you can't trade in it now. Your investment has no value. Rights issues, as I've said, if the company is using it to cover losses, I think there have been some stocks on the local market that have had to resort to this, and the share price reflected it. I think there was a negative reaction to that rights issue, and then takeovers. If you're invested in a small company, takeover can actually be negative because often the acquiring company doesn't fit your profile of what you want to be invested in, and it actually results in a culture change. So I would be careful of takeovers, and then reverse stock splits is probably your biggest warning sign that the company you're invested in is in financial distress, and often leads to a lower stock price. So look out for those.
Yeah, I think, when you talk of rights issues, very, very rarely is it a positive. Often, it does indicate some kind of underlying financial stress. There were outliers, and I think most recently Omnia went through a couple of rights issues, and the new CEO, Seelan Gobelsamy, when he came in, he's really turned that business around. But to me, it also is an indication, isn't it, of the importance of leadership. And, a CEO can either boost confidence or they can wipe billions off a company's market cap overnight. How much weight should investors place on leadership changes? And what are the red flags or green lights that they should be looking for when a new CEO is announced?
So I think I'm so glad you raised this, Michael, because to my mind, this is the most important event when there's a leadership change. It has such a massive impact on the company's ability to deliver on their strategic objectives. But also it's not just a short-term impact like the other corporate actions and events we've spoken about. It has such a long-term impact on that organization. And I think it's important when it is announced, read up about it, because often these companies, they justify why the new CEO is joining. Often he's joining because he can contribute to delivering on their strategic focus, and the organization has to benefit from it. I mean, a new CEO, in my opinion, is generally seen as very positive. There has been instances where it can be negative. I have actually this year, it's quite personal for me because I have an investment in an offshore company. It's called United Healthcare. They've been the darling of the healthcare stocks since the early 2000s. And they recently announced a leadership change. And when they announced basically the incumbent CEO stepping down, and their share price went from $600 to $266. So the market panicked. And then it was right to panic because shortly after that, it wasn't announced by the company, but there was a news article highlighting that there was potential that the company had been involved in medical fraud. So, CEOs step down for a negative reason. New CEOs join for potential positive. So in this instance, as much as the share price has dropped materially, I'm still invested. I still believe in the company, and I'm excited to see how the new CEO will bring the company back onto its firm footing, and get its strategic direction back on track. But I think fundamentally, the CEO is not just important because he delivers on a strategy. He drives the culture. He's able to attract top talent. It is the most critical event that I think shareholders need to pay close attention to in impacting their portfolio.
And I think what you've also just highlighted is your reaction to that news, because I think many investors might have panicked. They might have sold right at the bottom rather than, say, let's stay the course. We've seen over a 50% drop. Let's see what the new CEO can do, and maybe we can recover that value. And I'm sure you've seen individual investors react in all sorts of ways to corporate actions. What are some of the biggest mistakes they make, and how can they avoid knee-jerk decision-making that tends to hurt long-term performance?
Yeah, I mean, I think investors, as always, must look at the financial results of the company. They must look at what is the actual reason for the CEO stepping down. This is a once-off event, in my opinion, with United Healthcare. So I know it's not going to be something that is going to sink the company. They still have a strong strategy. They have a strong balance sheet. So I'm going to ride the wave with them because I believe in their strategy and their execution. And what's also interesting, they've actually brought in a previous CEO who knows the business. He was basically the CEO that brought them up to that $600 share price. So I've got absolute comfort that they've got the right man in the job to fix where they are right now. But I think, we often talk about some investors put these stop loss in if the price moves by 8%, then they sell their holding. I completely disagree with it. If you buy a share, we always talk about you buy it for the long term. You need to buy a share that you're not just there for a couple of weeks or a couple of months. You are invested, you believe in their strategy, and you want to participate in their downside and upside, because maybe the downside you can buy at great entry levels. But if this does intimidate you and you resort to, oh my gosh, what does this mean? Do I need to flog it like everyone else is? This is the perfect time for your financial advisor to step in and give you a bit of context as to what's going on and give you comfort that you still need to remain invested because the share is a good share for the long term.
Yeah, and I think, again, highlighting the importance of good financial advice just to guide you and be that sounding board and those guardrails through this journey, which can be a bit like a roller coaster, as you've described. Now, I'm sure any Sasol shareholder out there will know just from the last couple of weeks how it's bounced around. Are there any corporate action trends that you're seeing in the market? Say an increase in unbundlings or spin-offs or rights issues? What are you seeing currently that investors should keep an eye on?
Well, I think if I look, I think offshore, for me, the activity there has been the stock splits, but that's just on the back of shares having these massive runs. What's interesting for me is that Google and Amazon didn't do it for a very, very long time. So I found it quite fascinating that all of a sudden they did it. I think they did it twice in the last couple of years, but most recently. So, it's interesting when a company changes course like that. I think, it's exciting for me to see when you have an unbundling, because I think there's value. I mean, even PSG, we did it, fairly recently when we unbundled, the PSG. So I think it's important for investors to understand the events, to understand how it impacts their portfolio. I don't think there's any kind of commonality in what's happening. I do think, though, that investors must consider those companies that stop paying a dividend. I think that is something that should make you very concerned. Sometimes companies do it because they have a bit of a cash flow issue in the short term, which is not too bad. But where they have a long-standing impact on not declaring a dividend, that's a warning sign for me. And I think advisors should really caution their investors for those stocks. I must be honest.
Well, there you have it. Corporate actions demystified. Wendy, as always, you managed to make the world of dividends and spin-offs and rights issues sound almost glamorous, which I think is no small feat. Thanks so much for your time.
Great pleasure, Michael.